Hey everyone, welcome back to the channel. If you've ever wanted to start investing but got stuck wondering, should I buy stocks? Mutual funds. What's the difference? You're in the right place. In this video, I'll break down what each one is, how they work, their pros and cons, and most importantly, which one might be best for you as a beginner investor. Let's make investing simple. Let's jump in. What are stocks? Let's start with the classic, stocks. A stock represents ownership in a company. When you buy a share of Apple or Tesla, you literally own a small piece of that company. If the company does well, the stock price goes up and your investment grows. You can also earn dividends, which are small cash payments some companies make to shareholders. The good? Stocks have high growth potential. You get direct control. You pick the companies you believe in. The bad? Stocks can be risky and volatile. If one company fails, your investment can drop fast. So, if you buy individual stocks, you need to research companies, follow earnings reports, and stay diversified, meaning you own several different stocks, not just one or two. Tip: never put all your money into one stock. What are mutual funds? Next up, mutual funds. A mutual fund is basically a basket of investments, usually stocks, bonds, or both, managed by a professional. When you invest in a mutual fund, your money is pooled together with thousands of other investors, and a fund manager decides what to buy and sell. So instead of picking individual stocks, you're paying an expert to do it for you. The good? Instant diversification. You own a little piece of many companies. Professional management. Someone else handles the decisions. The bad? Higher fees. Fund managers charge an expense ratio, typically around 0.5% to 1% per year. Less control. You can't choose what's inside the fund. Trades happen once per day. You can't buy or sell shares instantly like a stock. Mutual funds are popular in retirement accounts like 401ks or IRAs, but their fees can eat into long-term returns. What are ETFs? Now let's talk about ETFs, or exchange-traded funds. An ETF is a lot like a mutual fund. It's a basket of stocks or bonds, but there's one big difference. ETFs trade like stocks. That means you can buy or sell an ETF anytime the market is open, and the price moves throughout the day, just like a stock. Most ETFs are passively managed, which means they simply track an index like the S&P 500 instead of paying a manager to make trades. The good? Low fees. Many ETFs cost as little as 0.3% per year. Diversification. You can own hundreds of companies with one purchase. Flexibility. You can trade anytime, even in small amounts. The bad. You still face market risk. If the market drops, your ETF can too. You'll need a brokerage account to trade them. In short, ETFs give you the diversification of a mutual fund, but the flexibility and low costs of a stock. That's why so many beginners, and even pros, love them. Putting it simply, so if you're just starting out and don't want to pick individual companies, ETFs or mutual funds are great beginner options. If you love researching companies and can handle risk, you might mix in a few individual stocks later on. Which one should you buy? Alright, so which one should you buy? Here's a simple rule of thumb for beginners. Start with ETF. They're low cost, diversified, and super easy to manage. Popular beginner ETFs include or SPY track the S&P 500. Covers the total U.S. stock market. Covers international stocks. For bonds and stability. If you're investing through a retirement account at work, like a 401k, you might only have mutual funds available, and that's totally fine. And if you want to learn and experiment, you can add a few individual stocks. Just don't put all your money there. Remember, the best investment strategy is one you can stick with long term. Quick example. Let's look at an example. Imagine you invest $500 in a single stock, say Company A. If it drops 30%, your whole investment takes a hit. But if you invest that same $500 into an ETF that owns 500 companies, even if one company drops, the rest balance it out. That's the power of diversification. It helps reduce risk and keep your portfolio growing steadily over time. So, stocks, ETFs, or mutual funds, now you know exactly how they work and which one might be right for you. If you found this helpful, hit that like button, subscribe for more investing tips, and drop a comment. Which one are you planning to start with? Thanks for watching, and remember, start small, stay consistent, and invest for the long run. See you in the next one.